Let's bring in former Federal Reserve Vice Chairman and PIMCO Global Economic Advisor Richard Clarida. Rich, I wonder, in the absence of the official government data, what your take is on where we are in the economy with that softening labor market, yet the rest of the capex-driven growth hanging in there, and how the Fed's current stance relates to it.
Well, you are right. We don't get official data. There's a lot of alternative data, high-frequency data, and I think it will show eventually, when we get the GDP numbers, a pretty strong third quarter ending in September. You are right. There are two big forces in the labor market. You've got reduced labor supply due to immigration policy changes, but probably reduced labor demand as well. The Fed has formed the judgment that it's worried about the downside risk to the labor market, and thus that's the rationale for the rate cut on risk management considerations. And then finally, I overheard your segment with Steve. You know, it may take a while for AI to show up in the productivity data, but it's already showing up in the economic data with CapEx spending and investment in software. It's a big driver. When we do get the official data, it's a big driver in the economy right now.
For sure. Yeah. I mean, and maybe one reason that, markets are okay for the moment with slightly less labor demand. So the game right now, I mean, based on what most of the Fed policymakers are saying, is there's room to get rates back toward neutral or to neutral, whatever that number might be. What does the path look like to you from here on into next year?
Well, I do think, especially after hearing from Chair Powell yesterday, that we are going to get that cut. It's an early meeting this year. It's, I guess, October 29th, not in November, so just in a couple of weeks. And I would expect one more cut after that. You know, as we get into 2026, we're really looking at the announcement of the new Fed chair nominee and the handoff at some point from Chair Powell to the new nominee. And so I do think, as you look ahead into next year, you have to start factoring in potential changes at the Fed. You know, we do agree there is some room to get rates down to neutral, which we judge to be around a funds rate of around 3%, which is sort of in line now with what's priced in. The mix between how much of that we get under Powell and how much we get under the next person is going to depend on a lot of factors. And then, of course, as well, the standard policy rule models, Taylor-type rules, would suggest that as long as inflation is staying above 2, and it certainly is above 2 for now, probably into next year, that you might take your time getting rates all the way down to neutral. So I think that's also going to be a factor as well.
We were discussing just a little while ago about how the longer end of the Treasury curve has traded. It's been relatively tame, right? I mean, I know Fed Governor Myron has pointed out that if cutting rates and expecting more cuts were viewed by the markets as a mistake, you probably would see rates go higher, as perhaps happened last year. So does that mean there's more room to get toward 3% quicker, or do we have to simply, see how inflation and expectations of inflation develop?
I think that's really going to depend on the next chair. I mean, as I said, standard analysis would be to cut rates towards neutral, but not really to get all the way there until one of two things happen. Either you've misjudged and you've thrown the economy into a recession, in which case, in a recession scenario, you cut below neutral, or inflation comes down faster than folks expect. You may have a new Fed chair who's more focused on rebuilding the supply side of the economy and contributing to that, and may take a different approach. But, the standard analysis would be to proceed cautiously so long as inflation is hovering above target.
Chair Powell, in his remarks yesterday, did sort of throw his support behind the idea of ceasing to shrink the balance sheet within the next few months. This has been something that's been handicapped roughly in that range. What are the implications of that?
Well, it's a good question. It's pretty well telegraphed. The Fed, certainly when I was there and continuing, the Fed does a pretty good job at telegraphing these moves. So, for example, earlier this year, they downshifted the pace of QT, I think really at the urging of Lori Logan at the Dallas Fed. And so the Fed's been doing QT, but at a slower pace. And so I think most folks, including us, have been expecting the Fed to stop QT probably in the first quarter of next year. So based upon what the chair said, and also based upon a pretty noteworthy decline in reserve balances in the last month or so, we could maybe see the QT coming to an end at the end of this year. So sometime in the next 3 to 6 months looks to be what the Fed is expecting to do.